Surely, you've seen in the news when you plan a trip to another country or when you are trying to buy something abroad that the price of the dollar, euro, pound, yen, among other currencies is constantly changing. In this video, I will tell you about the market that moves the biggest amount of money in the world, the currency market, better known as Forex. Forex is a market in which there is an exchange of currencies. Dollar for yen, euros for British pounds, Australian dollar for Canadian dollar, among many others. Any official currency of one country can be exchanged for the official currency of another. Well, almost all of them. Most of the transactions in this market are made by banks and financial institutions. However, you too can participate and benefit from this market. Let me show you how. In Forex, the exchange of currencies is represented by pairs. For example, the Euro-USD is the exchange of dollars for euros. If you buy this pair, you will be buying euros with dollars and you will benefit if the euro gains value against the dollar. If you make a short sale, you will benefit if the dollar gains value against the euro. As you can imagine, due to the size of their economies, trust in their governments, and widespread use, there are currency pairs that move a large portion of all transactions that occur in this market. These are Euro and US dollar, Pound sterling and US dollar and Japanese yen, Australian dollar and US dollar and Swiss franc, Euro and Pound sterling, US dollar and Canadian dollar. Forex is a decentralized market. In other words, it does not have an exchange like the stock or futures market. However, you can trade through brokers, but you must be careful about which one you choose and make sure it is regulated and has extensive experience. Like any other asset, Forex prices move by supply and demand. Higher interest for the euro-dollar pair will cause its price to rise and less interest for its price to fall. There are three main factors that affect the supply and demand of a currency. The first factor is monetary policy. Each currency is issued by a central bank. These banks regulate the amount of currency in circulation and the interest rates at which loans are made for this currency. The US dollar is issued by the Federal Reserve, the euro by the European Central Bank, and the yen by the Bank of Japan. If the central bank that issues the currency lowers its interest rates, more money will enter the economy through credits, and the price of this currency will have pressure that can lower its price. If rates are increased, there will be less money and therefore its price will tend to rise. The second factor is the situation of the economy that issues this currency. Economic and industrial growth, decreasing unemployment, among many other macroeconomic data favorable to the economy, will cause the price of the currency to increase. The third factor is international trade. When a country imports more goods than it exports, its currency will lose value, and if a country exports more goods than it imports, its currency will increase in value. Fortunately, to operate in Forex, you do not need to fully understand all these concepts. Every day, pages such as Forex Factory, Daily FX, Investing, Forex Live, among others, publish macroeconomic data from the main economies and tell you how relevant it is to the currency. In the Forex market, you trade in lots. A lot represents the amount of the main currency that is bought or sold in a trade. There are several types of lots. A standard lot represents 100,000 units of the main currency in the pair. In other words, when it comes to buying a lot of euro-dollar, it refers to the purchase of 100,000 euros. Mini lot represents 10,000 units of the main currency in the pair. Micro lot represents 1,000 units of the main currency in the pair. Unlike stocks or futures, in which the exchange units are not divisible, in the foreign exchange market it is possible to buy half a lot or a quarter of a lot, with restrictions that vary depending on the broker. The pip in Forex is equivalent to a minimum price movement that a pair can have. The variation of the pip will depend on the pair that is being traded, and the value of this variation will depend on the size of the lot that was traded. For example, for the euro-dollar, the minimum variation is usually 0.0001 in most brokers. This variation, when a standard lot is traded, has a value of $10, a mini lot $1, and a micro lot $0.1. As in other markets, in Forex, traders can resort to leverage. Leverage allows traders to invest more money than they have. Through this way, they can earn more money, but they can also lose the one they have faster. It is an extremely useful tool when used well, but you need to be very careful. All currencies are interconnected and maintain a balance. If the price of the euro rises against the dollar and the dollar rises against the yen, then this will be reflected in an increase in the euro against the yen. Whenever an imbalance occurs, traders immediately take the opportunity to make a profit, buying one currency and selling another. In this way, these imbalances are usually quickly corrected by the market. Currencies can be traded through markets such as futures. Because it is a highly regulated and centralized market, trading currencies through the CME can be more reliable and in many cases easier. If you want to know about the futures market and how can you start to invest in a simple way, click the animation video at the end of this one. And don't forget to subscribe and turn the notification on so you don't miss any more videos about the stock market, trading, and much more. Follow us on Instagram so you never miss our weekly updates. See you soon.